Is the silver market a fair playing field, or are you witnessing the greatest orchestrated wealth transfer of 2026? On February 12th, the world watched in stunned silence as silver, the devil's metal, suffered a catastrophic 10% flash crash in a matter of minutes. One moment, investors were eyeing a breakout toward $90. The next, the screens turned a bloody red as the price plummeted from a high of 84.88 to a gut-wrenching 74.58. Was this a genuine collapse of value or a calculated stop-loss raid designed to shake you out of your position? If you think this was random, you aren't looking at the data. According to reports from Forbes, this wasn't just a silver story. It was a contagion. As tech stocks buckled under renewed fears that the Federal Reserve would keep interest rates higher for longer, a wave of broad liquidation swept the markets. But while gold stumbled, silver fell off a cliff. Why the disparity? To understand the why, we have to look at the invisible hands pulling the levers of the COMEX. Welcome back to Collapse Now. I am your host, KO Nate. If you are interested, then hit the subscribe button and leave a like and comment. Just days before the crash, on February 6, 2026, the CME Group, the ultimate arbiter of paper-silver trading, quietly turned the screws. They hiked margin requirements for COMEX 5,000-ounce silver futures from 15% to 18%. According to Reuters, this was the third such hike in less than 2 weeks. Ask yourself, why increase the cost of doing business 3 times in 14 days? When margins go up, traders using leverage are forced to either inject massive amounts of cash or sell their positions immediately. It creates a vacuum. It creates a panic. And most importantly, it creates a forced flush of the very retail investors who were betting on silver's rise. As Kitco News aptly noted, this was a sharp decline fueled by forced liquidation rather than a shift in the underlying reality of the metal. If the world suddenly needed less silver, why did the physical markets refuse to follow the paper trail? While the COMEX price was screaming sell, the Shanghai Gold Exchange was screaming buy. On February 9th, just before the crash, silver in Shanghai was trading at a staggering $8 per ounce premium over Western prices. According to data from the Shanghai Gold Exchange, their silver inventories have plummeted to near 10-year lows, dropping to 318,546 tons as of February 9th, 2026, down from 349,900 tons just days prior. Disclaimer: the information provided in this script is for educational and informational purposes only and does not constitute financial, investment, or legal advice. Precious metals markets are highly volatile. Always conduct your own research and consult with a certified financial advisor before making any investment decisions. The divergence is staggering. You have a paper market in the West controlled by margin hikes and high-frequency algorithms, and a physical market in the East that is literally running out of metal. Is it a coincidence that the paper price crashed exactly when physical demand reached a boiling point? JP Morgan, in their recent 2026 commodities outlook, revised their silver price forecast upward, seeing an average of $81 per ounce for the year. If the biggest players in the game are raising their targets, why would they want the price to stay high while they are still accumulating? Consider the paper versus physical war. The Silver Institute, the primary authority on silver supply and demand, has projected that 2026 will mark the 6th consecutive year of a structural market deficit. We are looking at a shortfall of 67 million ounces this year alone. Where is that silver going? It's not sitting in vaults. It's being vaporized into industrial applications. Solar energy production is now consuming over 200 million ounces per year. Every AI data center, every electric vehicle, and every 6G telecommunications tower requires silver. According to Bloomberg NAF, silver is the indispensable element of the green energy transition, and yet mining supply from major producers like Mexico and Peru is stagnant. Now look at the recovery. If the February 12th crash was a true change in trend, silver should have stayed down. Instead, it behaved like a coiled spring. By February 13th, silver surged more than 3%, reclaiming $77.40. What was the catalyst? The January 2026 Consumer Price Index (CPI) data. According to the U.S. Bureau of Labor Statistics, annual inflation cooled to 2.4%, below the 2.5% forecast. This single data point sent the U.S. dollar index (DXY) reeling and signaled to the market that the Federal Reserve's pivot to lower rates is not a matter of if, but when. Trading Economics reported that silver showed remarkable resilience, clawing back nearly half of its crash losses in a single session. Are we witnessing a repeat of history? Historically, when the gold-to-silver ratio reaches extreme levels, silver eventually catches up with a violent move to the upside. Currently, the ratio sits near 65.1. In a world where silver is being consumed faster than it is being mined, many analysts believe a return to the historical average of 15.1 or even 30.1 is inevitable. HSBC, while more conservative with a $68.25 average price prediction for 2026, admitted in their February metals report that physical tightness remains a persistent risk to the upside. The data tells a story of two different worlds. In one world, you have the weak hands, retail traders who got wiped out by the February 12th margin calls. In the other world, you have the smart money, industrial giants and sovereign entities who use the 74.58 low to sweep up physical bullion. Look at the iShares Silver Trust, SLV, flows. Despite the price drop, retail and institutional ETF holdings remained remarkably stable throughout the crash week. The conviction isn't leaving, it's intensifying. Predictions for the remainder of 2026 are now becoming bolder. If silver can maintain its footing above the $75 support level, the technical path to $100 becomes a mathematical probability based on the current deficit. When you combine the Federal Reserve's inevitable rate cuts, which lower the opportunity cost of holding non-yielding assets, with a physical shortage that is being reflected in Shanghai premiums, you have the perfect storm. The February 12th flash crash was not the end of the silver bull market. It was the clearing of the deck. By flushing out the leverage and scaring the speculative money, the market has created a launchpad effect. As we move toward the March futures delivery dates, all eyes will be on the COMEX vaults. If the delivery notices exceed the available registered silver, the paper-to-physical decoupling will accelerate. The facts are clear. The margins were hiked, the paper was dumped, but the physical metal is disappearing. Silver isn't just a commodity anymore. It's a strategic industrial necessity in a world that is running out of it. You've seen the data from Forbes, the warnings from Kitco, and the supply deficits from the Silver Institute. The question isn't whether silver will moon. The question is, who will be left holding the physical metal when the music stops?